ค่ะขอต้อนรับการนำเสนอข้อมูลในไตรมาส 2ของบริษัท Psl Shipping จำกัดมหาชนนะคะโดยคุณคาลิดฮาชิมกรรมการผู้จัดการบริษัทและคุณกอตัมกุรณากรรมการทางด้านการเงินและในช่วงสุดท้ายในเรื่องของคำถามคำตอบที่จะมีนะคะค่ะขอเชิญคุณคาลิดค่ะ
Good afternoon, everybody. As usual, we will break up the presentation into two parts. We will show you the industry structure in the first portion, and then in the second part, Gautam will take you through the financials of the company. So here you can see clearly that pressure shipping is in the handysize and the super ultramax sector, as well as having a few dedicated cement ships. This is a long view of the Baltic Dry Index, and you can see that it's an extremely volatile index and has been quite volatile ever since 2003. If you were to look at the same chart but on an annualized average basis, then you would see that in 2016 we had the lowest ever BDI in history. And the lowest average BDI in history was in 2016, and you had the second lowest was in 1986, and the third lowest was in 2015. If you look at the BDI at quarter 3, up to the end of July, it's an impressive number, and it shows you that the freight markets have the ability to bounce back very quickly. Because if you look at the first quarter of 2019, it was quite a low number. And yet, by the third quarter, the number has more than doubled. If you look at the BDI on a daily basis, starting in January 2016, and working your way right up to the current position, then you would see a sort of if you look at the high point, you would see that there is sort of a trend line. And despite the fall that was there at this portion, that is in the early part of 2019, the trend line is still being maintained. So there's a very clear trend line going upwards. If you look at the BDI and then look at the amount of ships being scrapped, you can see that there is like a sort of an inverse relationship. So if you were to look at the first quarter of 2016, you can see that almost 15 million deadweight tons of ships were scrapped at the same time as the BDI was 50% lower than the lowest average BDI in history at that point in time in the first quarter. So when you have a low market, you have a lot of scrapping. And as you can see for the whole year, we had almost 30 million tons of ships scrapped, and the freight market was pretty low. The BDI was pretty low. Now, as the BDI starts to go up, you can see clearly that scrapping starts to come down. So if you look at 2019, we had almost 30 million tons scrapped. And yet, if you look at 2017, that has dropped to half that level. And the BDI, in the meantime, has more or less doubled. Now, if you come to 2018, it was a profitable year, and you can see that very few ships were scrapped during 2018. So 1/3 of what it was in 2017. And if you look at this year, in the first half itself, we are already well above what was being scrapped last year. So question then comes up, is China's growth sustainable? Now, if we were to look at China's growth, and if you look at iron ore, you can see that we are going to end up the year just on an averaging out basis at more than 1 billion tons of cargo. Similarly, if you look at coal imports, it's up 3.2% up to the middle of the year. Then in July, it was up much higher, and it will end the year, if it goes as per the same thing, at a much higher level, around 10% up from last year. Similarly, if you look at steel production, it's an amazing year for China. It's already up 10% in the first half of the year, and July was up again further. So you're going to have a very, very strong year. Almost 1 billion tons of steel will be produced in China this year. And just to put this in context, the number 2 nation in producing steel is India today at about 112 million tons. And the number third nation in the world is Japan, which is producing around 100 million tons a year. And America, for all its might, is at the 85 million ton production mark. If you look at the consumption of steel in China, last year was up by 11.3%, and this year also looks like it's going to be up in a similar way. So China is not just simply producing steel, but it's also actually consuming it at a very high level. So this is the same thing, but in a graphical form. Similarly, for import of soybeans, same thing, but in graphical form. And again, you can see in the month of July, there's been a big jump in the importation of soybeans. Despite the trade war, the reason why soybeans this year have been lower than last year is only because of the Asian swine flu, which has removed a lot of the herd, or the herd has to be killed, slaughtered to make sure that it works, that the disease is eradicated. That's the only way. There's no cure for it. You have to just simply kill the flock that has got it. Similarly, for steel production, these are just a bar chart to show the same numbers that I've given you, and same with steel inventory and with steel exports. So here are the numbers. Now, if you look at the numbers, it's very interesting. China's GDP growth rates have been coming down on a steady basis. And yet, if you look at iron ore importation, it has actually been growing in a good way. Similarly, if you look at coal imports, has been growing in a very good way. If you look at steel production, amazing numbers coming out from China. And if you look at steel exports, was going up very sharply till 2015. Thereafter, it has come down. And China is trying to consume more of its steel rather than export it. This is a compilation of all the dry bulk trades, all the cargoes that move in the dry bulk market. And you can see clearly how that has been moving. And the main thing to note here is really the numbers at this point, which is the minor bulk growth. This one being the growth in so this is the minor bulk growth, and that's important for us. So if you look at the brown bars, they will show you how the minor bulk growth has been progressing. Now you can see the same thing, but in more detail, as well as what we've done here for you, we've given you two things to look at. This purplish bar shows you the growth in total minor bulks, and this bar, the darker bar, shows you the net growth in supply of ships. So in 2016, remember the market was very poor. One of the reasons was that demand was growing slower than supply. Now if you look at 2017, it's just the opposite. Demand has grown higher than supply. And the same thing happens in 2018. Now 2018 became a profitable year. Now in 2019, this gap has narrowed down. So demand has slightly slowed down. And if you look at 2020, the forecast for supply is much lower, and therefore we should have a nice uptick in the freight market during 2020. This shows you the historical cargoes that we've been carrying. You can see clearly that out of the roughly 12 million tons of cargo that we carry per annum, you can see roughly that agricultural commodities is roughly running at about 2.5 million tons. So roughly you could say that 20% of our cargoes are we carry is agricultural commodities. Cement is very high, and the reason for that is we have 4 dedicated ships just carrying cement right through the year. If you look at then coal, we are carrying on an average, you could say, about 2 million tons of coal per annum. So again, it gives you about the 17-18% mark. And then the next big one is ores and concentrates. Please remember here, it's not iron ore, it's all other ores and concentrates. And then if you come to steel, that's the other big number that we have. Fertilizers is then followed by that. So these are the principal cargoes that we carry. So coming to the supply side and what's happening there. So if you look at this supply side and look at the lowest number here on the rightmost column, you can see that the net addition in the supply side has been 18.68 or say 19 million tons of ships during the first 7 months of this year. Now, what is the balance supply still to come? So if you look at the balance supply still to come in 2019, you can see it's 24 million tons or about 2.83%. Then you've got another 5.67% in 2020, another 2.17 in 2021, and then 0.26% in 2022. Now, of these ships, of these ships which are there, say this 93 million tons, which is still to come all the way up to 2022, you can see that of that, the majority of ships will be on the gearless side. So gearless ships will be 72 million out of this 93 million tons in the future, or roughly 78% of that. And 21% or 22% will be from the smaller size. Okay, so it shows you that the smaller sizes, the supply side is not going to increase as strongly as on the larger sizes. This is the graph that shows you the ordering of ships in any 1 year as compared to what's happened to the BDI. So if you were to look at that and look at the year 2007, you can see that we ordered 170 million tons of ships almost, and the BDI was at a very high level in those years. And then soon after that, we ordered another 100 million tons, 100 million tons, and then again 100 million tons. So all this over-ordering has finally been absorbed in the system coming down to 2018. This shows you the amount of ships being delivered in each year in 2018 and 2019. And against that, you've got the ships that are being scrapped. So the scrapping is the lower yellow bar, and the green bar on the top is the deliveries. So you can see the January impact which was there in 2018. Yet in 2019, you don't see that January type of impact anymore because it's become much more evenly spread out during the year in terms of deliveries. And again, in terms of scrapping, you can see that in 2019, very little ships were scrapped. And the same applies in 2018. Almost very, very little ships were being scrapped during that year. This is an annual average of all the ships all the net changes that have taken place. So if we were to look at the first lot of ships or the first 8 years, you'll see that there was a compounded annual growth rate of about 6%. The next 8 years had 7.41%. And now if you look at the annual growth rate, it's around the 3% mark. Now this is a much more normalized growth rate. If we were to look at and try and do a regression analysis from the world GDP growth rates as given by IMF and then compare that with the ton-mile growth rate in dry bulk, then you would see that there is a strong relationship, almost a 98% correlation between these two numbers. And if you would then try to look for a rule of thumb, you would see that around 106 basis points, if you were to add to world GDP growth rates, you would come to a very likely prediction for the growth in ton-mile demand for dry bulk. Now, looking at the order book, and what does that show us? So if you look at the order book, you can see that the order book right now, as of the end of July, is at 12.45% for the entire dry bulk fleet. And that, if you compare with the percentage of the fleet which is already over 20 years of age, is 7%. So you have slightly more ships being built than there are older ships. But if you were to extrapolate the 20 years plus fleet into 2022, then you would see that the new buildings and the overage ships are roughly similar. Now, this is for the overall dry bulk fleet. But if you look at what's going on in the handy size sector, it's very interesting. The order book is at 6.38%. The current over 8 ships or over 20 years of ships is 13.8%. And if you were to extrapolate that up to 2022, you would have almost 17%. So you can see that the handy size fleet is falling away but not being replaced. And the reason for that is that the Supramax fleet and the Ultramax fleet is got a 9.42% order book with an 8.64% of 20-year-olds as of today. And if you were to extrapolate that up to 2022, then it's 12.14%. So here also, the supply of new ships as compared to the existing old ships is very, very decent. This comparison is a really good comparison and shows you that in the future, supply of dry bulk ships in the handy size and in the Supramax and Ultramax sector is going to be pretty restrained. Coming to trade wars and tariffs, you know, in the past, everybody would say that China was an export-led economy, but that no longer holds good today. Today, 60% or more of China's GDP is from domestic consumption, and therefore exports are not that relevant anymore for China. So Donald Trump's tariffs and trade wars that he's trying to perpetuate against China is not really harming China's economy in any way, and we can see that from the number of the imported commodities that are coming into China. Secondly, trade sanctions and tariffs in and of themselves cannot really change demand. I mean, demand doesn't change just because the government decides that you have to pay an extra tax on coffee. You might have that coffee and change your demand from coffee to tea and have an equivalent product. So trade sanctions and tariffs in and of themselves just make the market more inefficient, which means ton mile will grow, which is good news for shipping. Now, these are the changes which are going to be there in the future in terms of the regulatory changes, and it's quite important to know that there are this many, and in fact there are more than this. We've just listed out the most important ones, but these changes will all put pressure on owners in terms of increasing their operational cost of their ships. And if you have an older ship, then your costs will go up disproportionately higher to comply with the new laws. And that's one of the reasons why people expect that the older fleet will die away quite quickly, will be recycled quite quickly. Now, the two major regulatory changes that are going to come up and are right now actually being, as we speak, is being implemented is the ballast water management system. And then the next one will be IMO 2020, where people can either put up a scrubber plant and burn bad oil or simply go ahead and burn clean oil. Now, this gives you an idea as to how this IMO 2020 has been established, when did it start and what's going on with it. So if you look at it like this, that since 2000, we've been burning 4.5% sulfur oil all the way up to 2012, at which point in time it became 3.5% sulfur oil, and now on 2020, it'll come down to 0.5%. If you look at the special emission control areas where instead of burning 4.5% sulfur oil, you were only allowed to burn 1.5% sulfur oil. Then this came down to 1% in 2010, and then in 2015, it came down to 0.1%. Now, if you look at these two lines and look at their origins and how they've come together almost, you can say that in a few years' time, this will come down to 0. So it looks like we will be burning 0 sulfur oil in the future. Now, what does IMO 2020 mean for ship owners? Basically, it says that it means that you have to make a decision. Should you buy a scrubber or should you burn low sulfur fuel oil? Or should you switch to LNG? So these are the three options that you have. And most ship owners are looking at the low sulfur fuel oil option. In dry bulk, less than 6% of owners are looking at the scrubber option and the LNG option, whilst 94% of the owners are looking at simply burning compliant fuel oil. Now, if you're burning compliant fuel oil, you have to make sure that the fuel is available. You have to make sure that the fuel cost is at a reasonable price. and you have to try to increase the freight rates to capture the additional cost that is there for the fuel. And so these are the things, and the question is that can you pass these increased costs to your clients? In most cases, the answer is yes. This is just showing you the numbers. As you can see over here, only 6.2% of the existing fleet will have scrubbers fitted on it. And in terms of LNG capable ships, less than 0.05% will have it in dry bulk. Now, this slide shows you that roughly 37 million tons of ships will have their 4th, 5th or 6th special survey coming up starting in Q3 2019 and ending in Q4 2020. So this is quite important. These ships are more than 20 years of age. They're going to have to do a lot of repairs for their special survey, and then they'll have to add the cost of ballast water treatment, and then the unknown that they would face whether those ships can actually burn clean oil or not. If you were to then break that down just to the geared ships, it's almost 16 million tons which would be facing this question. And here if you can see clearly that the 25 and 30-year-old ships are quite large. You can see, and only and it's really, I mean, it's a good balance between 25, 30 years against the 20-year-old fleet. So we have much more older ships than the rest of the world fleet. So what is the regulatory impact of low sulfur fuel oil? Supposing that none of these ships are scrapped or recycled and they all come up to 2020, then you would see at the beginning of the year 63 million or 64 million tons of ships would be, or 7.4% of the existing fleet would be over 20 years of age. And by the end of the year, that number would have gone up by 10 million tons or 8.6% of the existing fleet to 73.2 million tons. So a lot of ships are really old, and some or a majority of them should actually go for scrap. Ship owners are a hardy lot. They will try their best to keep these ships running, but because of these regulatory pressures, we feel that scrapping will definitely increase in the first quarter of 2020. Now, this is a slide which tells you what the oil majors are doing about low sulfur fuel oil and its availability. So I'll leave that for you to study. It's all taken from press reports. We've given you the web links to that. Now, what will owners do? Owners will, of course, the first thing they will do is to try to reduce the additional cost by burning as little clean oil as possible. This can be done by slowing the speed of the ship. If you do that, daily consumption would drop. Most owners would reduce speed by about, say, 2 knots, which means that if you were doing 12 knots and you were traveling 57,600 nautical miles, if you reduce it to 10 knots, you'd only travel 48,000 nautical miles during the year. So which means that the difference between these two numbers is almost 17%. So 17% of the supply would be absorbed by slow steaming if the ship owners go from 12 knots down to 10 knots. So if they reduce it by 2 knots. Now, we don't know how this will play out because even today, nobody has an idea as to how expensive low sulfur fuel oil is going to be. Today, you could buy low sulfur fuel oil at a premium over high sulfur fuel oil between $50 and $150. Now, if it's at this type of number, definitely ships will slow down, but may not be to the extent that we expect of 2 knots. It might be to maybe a half a knot or 1 knot slowing down. So instead of 17% of reduction in supply, you might have something between 4 and 6% of reduction in supply. So our strategy is that once the market reacts to this and rates go up, we will start fixing our ships on long-term contracts. We expect that this might likely happen during 2020. So this is a snapshot view of the company. We have currently got 36 ships. The average age is 7.25 years. The insured value is 700 million. The book value is 676 million. The total deadweight is about 1.6 million deadweight tons, and it's about 44,000 tons per ship. This is our forward 4-year book, and if you look at this, you can see that the contract value is roughly about $30 million per year, which we've already pre-booked. Now, keep in mind, these are all long-term contracts which are more than 1 year long. Anything less than 1 year, we don't report in this slide. If you look at our performance in Q2, the Baltic Handysize Index was at 407 points, or equivalent to $6,077. Against that, our Handys averaged 8,717 and therefore outperformed the index by about 43%. If you look at the Supramax Index, it was at 754 points, averaging out to $8,192 per day per ship, and we averaged 9,071, so a 11% premium to the market. If you look at Ultramaxes and compare them with the Supramax Index, because there's no index as yet for the Ultramax, we outperformed the index by 17% and at 9,600 compared to 8,192. So to summarize, 2017, 18 and 19 has taught us simply that demand-supply balance is really very close, leading to an almost profitable year for all and a lot of volatility. The minute demand drops by a little bit, rates come down significantly. If the demand goes back up by a little bit, rates go up very significantly. 19 and 20, the expectation is that demand growth should be about 1 to 2% higher than supply growth and lead to increasing profitability. The order book to existing fleet ratio compared with percentage of ships over 20 years of age shows that supply will remain tight in the future. 2020 could be an extremely, 2020 could be a very interesting year. Slow speed and scrapping will remove a lot of the supply, and we could get a big bump in rates. Cost of capital is high and will remain high especially for non-listed companies because of Basel III for bank lending, and that will again put new buildings, ordering of new buildings on hold. And the future environmental rules are coming out thick and fast, as I showed you on the regulatory slide, and therefore that will also have an impact on people wanting to buy brand new ships, because you'll have to almost certainly retrofit them with many new of the new regulatory changes. The two areas which are scary are still geopolitical risks and the use of tariffs by Trump. Not that the tariffs are having an impact directly on dry bulk, but what they're doing is they're creating a very negative sentiment on the economic front, and as a result, if you look at IMF, they have been downgrading the economic growth rate for the world at every new projection that they make. Now with that, I'll hand you over to Gautam, who will take you through the financials of the company.
Okay. So for the second quarter of this year, we reported a net loss of 4.39 million. This was below the net loss of 2.63 million that we had in first quarter of 2019, and also it's below what we had in the same quarter of last year. We had a profit of 2.93 million. This was mainly due to lower average time charter income per ship per day, which came in for the quarter at $9,002 compared to $9,273 in the previous quarter and $10,767 in the same quarter last year. The average ship running cost per day was 4,934, which is higher than the 4,816 figure in the previous quarter and 4,519 in the same quarter last year. The gross profit margin was 46.76%, and the net profit margin was 13.87%. Another factor which caused this loss was the implementation of the Labour Protection Act in May. So this was an extraordinary item for this quarter. Our liquidity continues to be quite healthy. It stands at 65.48 million as of 30th June 2019, down from 74.79 million on 31st December 2018. The advances to Sainty Shipyard, with whom we are currently in arbitration, stands the same, stands at 64 million. The total assets figure is down from 857 million at the end of last year to 846 million at the end of June. This is due to depreciation. The total debt, total long-term secured loans, stands at 261 million, down from 278 million at the end of December last year. Debentures stands at 179 million, which is in nominal terms appears to have increased from 169 million, which is the figure that was there on 31st December 2018. However, the debenture has a cross-currency swap, and so the actual economic exposure for us is 154 million. That remains the same. Total shareholders' equity has declined from 391 million at the end of last year to 383.92 million due to the loss. The book value per share is 7.57, again down from 8.14. And our total liabilities to equity ratio stands more or less at the same level. It's at 1.2, thereabouts. This chart shows the operating expenses in granular detail for each of our ships on average. So the average total operating expense per ship per day was 4,875 for the first half of 2019. This is slightly above our target of 4,750 per day. The reasons for that are higher dry dock special survey expenses, higher stores, spares expenses, and also slightly higher lube oil expenses. These expenses are mostly sort of one-time expenses because they're related to the regulatory changes that are coming up on 1st of Jan 2020. This chart shows our average operating expense, excluding dry dock and special survey, compared with the average industry operating cost. These figures are the comparison figures for 2017. The 2018 figures are yet to be published. In 2017, our operating cost was almost $1,000 lower than the industry average. Now, every $1,000 increase in average earnings adds $10 million to our bottom line. So this is quite important. This gives us quite a big competitive advantage. This chart shows at the top line before the year column, it shows the average age of the fleet initially first. So from 1995 up until about 2011, the average age of our fleet was about 15. Thereafter, it starts to decline as we took delivery of a number of new ships which were larger. So if you look at the orange line, you'll see that the average deadweight was initially in 1995 was 19,000, and then it gradually sort of moved up to, in 2010, it was 24,000, and then it starts to move up quite rapidly as we started to take delivery of Supramaxes and Ultramaxes. The yellow line shows the average time charter rate. So in 1995, $7,300 was quite a good rate. The market then declined because of the Asian financial crisis. The low point at that time was in 1999 when rates came down to 4,800. And then they started to gradually move up, in a large part driven by Chinese demand, China joining the WTO. And there were two peaks. Initially, first in 2005, when the average time charter rate went to 14,449, and then again in 2008, when the average time charter rate went to 16,499. Thereafter, due to supply issues, due to overbuilding in the industry, rates started to decline gradually. And then they reached a trough in 2015-16, where we saw the average time charter rate was 6,200 in 2015 and 6,400 in 2016. And then since then, some of those supply pressures have eased, and so rates have started to move up again. And so last year, the average rate was 11,000. This year, it's 9,000. The line below that in green shows the average operating cost per day for each of our ships. And that its lowest point was in 1998. And then it started to move up a little bit as the fleet began to age, and it peaked in 2009. It was at $5,000 per day. And then it's maintained a relatively stable level ever since then, and currently it's about $4,800, $75 per day. As I said, which is still about, this includes special survey and dry dock and other administrative costs that we have. So this is not the industry figure that I showed in the previous slide, but it just, this is very, very competitive compared to what we see in the industry. Okay, this slide shows the evolution of our debt and also the debt to equity ratio over time since 1993. You will see that initially debt levels were elevated in the 90s, in the late 90s during the Asian financial crisis. They started to come down because we implemented a strategy to reduce our debt. Then we acquired a fleet, went up again, went down again. We paid down our debt to zero. And then again, you start to see an increase as we started to acquire more ships. And we funded those ships with much of that with debt. But now we're in the repayment phase. Debt to equity as well is a similar cycle, I think. So 2016, we were at probably at the peak level, 1.3, and our strategy is to decrease that number going forward. This chart shows the debt to EBITDA figure as calculated on one of our loan agreements. So actually, this is total liabilities by EBITDA. What this shows you is this numbers remain quite stable, or it was initially in the late 90s, it was at the 6th level, and then it came down as we repaid all our debt. And then it started to move up again as we took delivery of a number of our new ships. And now again, rates, as they've gone up, EBITDA has gone up, our debt is going down, this ratio is going down. This figure, this ratio, does not take into account the cash that we hold on our balance sheet. This chart, the green line first shows the cash operating P&L. So that's just EBITDA minus interest. So you will see that in most years, even in years when we reported a net loss, on a cash basis, on a cash operating basis, we were still positive. The yellow line is operating P&L, so EBITDA minus interest minus depreciation. Same thing, this is now net profit, and the yellow line shows net profit plus depreciation. So when you add back depreciation, you see the actual cash effect. You'll see that in most years, we've been cash positive, even if the years have been weak from a financial statement perspective. This shows the dividends that we have paid over time. Our policy is to pay no less than 25% of net profits as dividends. Due to weak markets since 2015, we haven't done so, but our intention is to start paying dividends soon. This shows our financial profile over a 5-year period. You'll see, for instance, our cash figure in 2014, it was 16 million, and then it was 12 million in 2015, and then it started to go up quite a bit, and we would say, maintained relatively healthy levels. Our gross debt, when we took delivery of ships, it peaked, as I said, in 2016, and then it started to decrease. It's starting to decrease. Net debt, after taking into account cash, that is also on the decline. Equity has remained relatively stable. Currently, as I said, 383.9 million. Number of vessels is 36. Net debt to equity, after taking into account cash, currently stands at 0.96, which is also on a declining trend. Debt to EBITDA is, as I said, temporarily up, but it's definitely down quite a bit from 2016 and also 2015. Precious Shipping was nominated as Ship Owner Operator of the Year in 2018 by Seatrade, Lloyd's List, and the International Bulk Journal. Our ship management subsidiary, Great Circle Shipping, was a finalist for Ship Manager of the Year, again by Seatrade and Lloyd's List. Also, one of our ships, the Apinya Nari, a cement carrier, was a finalist for Bulk Ship of the Year nominated by the International Bulk Journal IBJ Awards in 2018. These are some awards that we've got in the past. So most recently, the PSL board was among 10 finalists for Board of the Year award for companies in our category, which is for companies with market cap less than 30,000 million baht. So in the past, we have won a number of corporate governance awards. We were overall best company in Thailand for corporate governance in 2014. We won Best Disclosure and Transparency in Thailand, and several other awards related to corporate governance. We believe good corporate governance is a must. It's very, very important for us, and for that reason, for the last 9 years, we've been given a 5-star ranking as far as corporate governance is concerned. These are some of the older awards that we received, again related to corporate governance. So quite recently, in August 2019, Precious Shipping was certified as a member of the Private Sector Collective Action Against Corruption. So also for the years 2012 to 2018, Precious Shipping has consistently been ranked among the top quartile of listed companies in terms of corporate governance in PSL's market cap category. So this is a ranking, financial performance ranking that is published by a New York-based magazine called Marine Money. Marine Money ranked us number 16 out of 97 global shipping companies in terms of financial performance for the year 2018. We were ranked second in our sector, which is the dry bulk sector. So out of 19 listed dry bulk companies globally, we were ranked second in terms of overall financial performance in the year 2018. This is a good ranking is something we're familiar with. In the past, from 2005 to 2012, we were ranked in the top 10 of 100 listed shipping companies by Marine Money consistently. In fact, at one point in time during that period, we were also the #1 ranked shipping company in the world for financial performance. This shows the total return to shareholders during the period 1993 to 2019. If a shareholder had invested 85 baht at the IPO, they would have their net cash position today would be about 11 times of their original investment. It's a very, very healthy return. As I said, there was consistent returns in most years. There's been a weak market since 2015, so not since then, but for the period prior to that, for the 22-year period prior to that, very consistent dividends. This chart shows the value of investment to shareholders. So the first column, if one were to have invested 1,000 baht in 1993 during the IPO, the value of your investment today would be about 12 times the original investment. Similarly, in 1995, it would be about 3.3 times. If you had invested in 2000, it would be about 50 times. So, and I keep going on. So 2005, it would be 1.1 times. Okay, 2015, ever since then, the market's been a bit weak. So the return is still a little bit below the original investment. With that, I end, and we open for questions.
Can you give it the mic?
Hello.
Yeah.
Hi, thank you for your presentation. In regards to your strategy, you commented that for the industry, only 4% were going to do the retrofit for the scrubbing, whereas 96% were then going to potentially sail the ships slower. What is PSL's strategy with your existing portfolio of ships? Are they all retrofitted already, or is the aim?
Okay, none of our ships are fitted with scrubbers. We plan to burn clean oil. The reason for that is that the legislation that has taken place on clean oil is an anti-pollution legislation. And the problem with scrubbers is that you are actually transferring the pollution from the air into the water. So you're not really doing what you're supposed to do when you take the scrubbers. 6% of the world fleet has fitted scrubbers, and they are mainly the very large ships, not the smaller ships. So the gearless ships, they mainly are fitting scrubbers. Geared ships are not really fitting scrubbers. And we are all trying to burn clean oil. Now, there is a question from the net. Says that what would happen to a ship owner if he were to burn high sulfur fuel oil after 1st January 2020? Now, the enforcement of this law is left to the individual states. So, for example, in a place like Singapore, if you were caught burning high sulfur fuel oil in their port, then they would not only fine you $100,000, but they would also jail your master for 2 years. So it's not, no two countries are equivalent. Like if you look at the European countries, it's really strange. It's not like a united European Union. For example, if you burnt non-compliant oil, in Germany, your fine would be about $22,000 per day. But if you did that in either one of its neighboring countries, then your fine could be as high as $6 million. That's the maximum. So different states have got different local legislation to enforce this. But the law is the same. The law is that you cannot burn high sulfur fuel oil anymore at sea. You have to burn low sulfur fuel oil. Or you have to have a scrubber which works. If your scrubber doesn't work, then they might fine you for that too. Now, many of the countries have also said that if you use one type of scrubber, which is known as an open loop scrubber, and which say roughly 85% of all scrubbers are like that. If you use that, then they say you cannot throw that water in our ports. Singapore has actually termed it toxic industrial waste. They consider this water so dangerous that they call it toxic industrial waste. And they say that if you have a scrubber of an open loop type, you cannot dump the water into the sea in our port. You have to discharge it to a reception facility which will charge you a fortune to clean that water. So different states have got different rules and regulations, but a lot of countries are saying, please don't dump this toxic waste on our ports. And the reason why ports don't want this toxic waste is that in the future, if the port ever has to dredge the soil that is there on the floor and this toxic waste is on it, then they will not be able to do that. Because once you disturb that, this toxic waste will go into the water. So ports say that for our future longevity and for increasing the depth in our channels, we cannot allow you to dump this waste in our waters. But just imagine that's like saying on an aircraft that certain seats are allowed smoking and certain seats are not, like very few seats are smoking and majority of seats are non-smoking. And what happens is that everybody smokes. And so the same thing is going to happen with open loop scrubbers. Right now, they're banning them from discharging the water in the port. In the future, they might ban them completely. So people who fitted scrubbers actually are treading a very thin line. As an example, Carnival Cruise Lines, which owns 150 ships, has been fined $60 million for breaking anti-pollution laws. Not only that, when they were under a court-appointed monitor and an environmental compliance plan legislated by the court because they got caught with so many violations, they found that their ships for 20 times, 20 specific instances where they were burning high sulfur fuel oil without the scrubber working. So scrubbers don't really work well, and Carnival has been using scrubbers on their ships for the last 10 years. So even with 10 years of experience, even with staff that have been used to this equipment, the equipment either broke down or was not monitored correctly or just simply failed to work 20 times in 1 year. So, and this is just what the court-appointed monitor has been able to find out. It may have broken down many, many more times, but that has not been reported. So they've been fined $40 million first and then another $20 million after this report came out. So people who use scrubbers are actually very close to being termed as environmental cheats.
So then your strategy will be to
burn clean oil.
burn clean oil.
Yeah,
Okay.
so there's no risk in that.
So, for example, like what you just commented that the IMO 2020 regulations would be decided by individual states, like
The punishment.
the punishments.
Yeah, the enforcement and punishment is going to be decided by individual state. The IMO doesn't give you a prescription for that.
Okay, so when we read that Indonesia, for example, doesn't want to do IMO 2020.
Again, there's a qualification there. It's only for their domestic fleet that they will allow 3.5% sulfur oil, only for the domestic fleet, not for foreign ships. They will enforce foreign ships very strictly, but for their domestic fleet, they will allow them because they say we have this much of 3.5% sulfur fuel oil with us. Till it's not used up by the country, we don't want to throw this away. So that's their reasoning. And the domestic fleet is very small. It's not a large amount of ships. Now, we have one more question from the net, again in relation to IMO 2020, asking us how will we manage this and what is the status of our preparation. So for management purposes, we are simply going to burn clean oil. In terms of preparedness, all our ships are already ready and prepared to burn low sulfur fuel oil. So we plan actually to convert or switch over to low sulfur fuel oil sometime starting in October or November or December on the ships, depending on availability of low sulfur fuel oil and the preparedness on the ship to have cleaned the tanks and got it ready to accept low sulfur fuel oil. We will start the process from October this year.
A question on the BDI. We read that in 2018 that the BDI was restated, as in the weightings of each, Supermax, Handymax, Panamax has been changed from its usual 25, 25, 25. Could you, like the chart that you show us, does that include the restating historically, or
No.
So if
no, it's okay. So we've asked this question from the Baltic Exchange itself. And the Baltic Exchange says that the new BDI compared to the old BDI, compared to the original BDI, or BFI as it was called, they say that changing the weightage makes no difference. So don't ask me the science behind it. I've tried many times to get them to admit that they're doing this for different reasons, but they say no. We think that this is the best method of managing the BDI. In fact, what you notice is that the volatility of the BDI has increased dramatically after the latest change, that is March of last year. Because now 40% of the weightage is only on one sector, Capesize, and that sector is exceedingly volatile. And that makes the BDI very volatile. And the sector that has the least volatility has been removed from the BDI calculation, which is the Handysize. So now it's just three sectors that make up the BDI. 40% weightage for Capes, 30% weightage for Panamax, and 30% weightage for the Supermax, Ultramax sector. No weightage for the Handysize. They calculate the Handysize sector index, but they don't put it into the BDI. Sure, please.
When you show us in the supply of ships coming online, say over the next 1, 2, 3, 4, 5 years, just back to the scrubbing, if 6% of owners are scrubbing their ships at the moment, is that included?
Including, the 6% includes the forward book also, okay. The ones which are already this thing. So what we've given you is an absolutely correct and fair picture. But it's mainly on the big size. I mean, I just saw a recent chart done by Clarkson's, and in the bigger sector, it is very, very prominent, but not in the smaller sizes. Okay, so we've got some more questions from the net. The third question is, what is the incremental cost after 2020? Actually, there's no further incremental cost to us after 2020, but our daily operational cost has gone up in preparation for 2020, and that's why you see a relatively higher number than we would have liked. Like, for example, in the second quarter, you saw something like 4,924 as the daily operational cost number. We would have ideally liked that to be around the $4,750 mark. But because we are doing the IMO 2020 preparatory work, this cost has started to go up. We have a fourth question from the floor, from the net, which is that asking us to express an expectation as to where will the BSI or the Supermax index go and where will the Handysize index go in 2020. I mean, first of all, we normally don't give forward-looking statements. So really, for us to comment on something like this would be incorrect, point one. Point two, forecasting in shipping is one of the most painful experiences because every single forecast is always 100% wrong. It's never correct. So really, to give an idea would be very difficult. All I would say is that 2020 will have a big impact in terms of recycling of ships as well as in terms of slowing down ships. So that should constrain the supply side. And if that constraint comes through, then both these indexes will go up quite sharply. How sharply it will go up and how long will it remain there, it's anybody's guess. So we've been told now that we've run out of time for the presentation, and I guess there are no further questions from the floor. So I would really thank you for being such an attentive audience. Thank you so much. Sawasdee krap.